Welcome to The Intentional Exit, a leadership legacy podcast for those who don't just want to retire, but want to do it well. I'm Rebecca Schriver, and this is where we help you protect what you've built, reduce unnecessary taxes, and create a plan that gives you clarity, confidence, and control. So together, we make sure your exit is not accidental, it's intentional. Before we begin, please note that the information shared in this podcast is for educational purposes only and should not be interpreted as tax, legal, or financial advice. For guidance specific to your situation, we recommend consulting with a qualified professional. While you were working, you spent a ton of money on taxes. And if you were a business owner, you spent even more. And as people move into retirement, they're often surprised to find out that their taxes didn't actually go down. If anything, they stayed the same, and I've even seen them go up, simply because of how those taxes are organized once you start moving into retirement. And if you aren't careful and you don't do the right things, you can end up paying an exponentially larger amount of taxes. On episode 18, we're going to talk about this thing called tax mitigation. It's one of my favorite subjects, and I know that I'm highly passionate about it because there is such a thing as tax mitigation, and it's not tax avoidance. It is simply putting yourself into a position through a series of decisions, through a series of calculations, and by using the IRS code to be able to work to your advantage instead of your disadvantage. I have watched several podcasts lately that have talked about tax mitigation. And it's funny because these podcasts that I'm watching aren't even built around it. They aren't built because, hey, let's talk about tax mitigation week after week. It's simply people who are highly successful, who are making lots of money, who are talking about how people do it better and how they hold on to more of their dollars, and how if you aren't using tax code to your advantage, you're actually moving your needle the wrong direction. Because in the United States, we have tax code that applies to everyone. Every single person who ever files taxes has tax code working for them or working against them. And the choice is really yours. When we look at tax mitigation, we are simply organizing ourselves and using a four-letter word. Right? Two people with the same exact amount of money. We love this one. It's the same exact amount of Social Security. We're using math with the same to be able to decide expenses and when to pay taxes in retirement. Very different outcomes simply based on whether or not they actually pay attention to the taxes and how they organize themselves in those first couple years, or even in the 5 years leading up to retirement. And so let's talk about why taxes are so ignored when it comes to people looking at retirement. And it's because we all have this false belief that we have zero control. Everybody believes that the government just tells you how much you owe, and then you go and pay it. And for those people who sleepwalk into retirement and who just follow conventional wisdom, this is going to be very true. They're actually going to pay the most possible in taxes during their retirement. However, if we take a step back and we look at how taxes actually function in retirement, and what can we do to systematically reduce those taxes over our lifetime, we can kind of cut the head off the snake. right? And I do think of taxes as kind of being a snake. It's that thing that wiggles in, takes what it wants, and then pulls it away, right? And so as we're looking at this, we know if we are in a profit sharing plan with the IRS, they're going to want their money. And a lot of our accounts are set up to be in a profit sharing plan. And people kind of go, okay, well, I'll just pay them all the taxes this year and then I won't worry about it. And while that may work, it can also leave you paying much higher taxes. It can leave you with less money. And so whenever we do this, yes, we want to pay the taxes because we don't look good in orange. Even though I'm wearing orange today, I don't want to wear it every single day. I don't want to wear it, in the form of a jumpsuit. And I would not like to have concrete walls and 3 squares. So how do we do this? Well, again, we are going to use the tax code to our advantage, and we're going to systematically look at how do we roll off the taxes, right? And how do we position ourselves into a tax-free account? How do we move from a fully taxable account to a tax-free account? And a lot of people think that if we're doing tax mitigation, we're just going to pay the taxes later. And actually, the opposite is true. We're going to choose to pay the taxes earlier in a specific amount at a specific time so that maybe as we move into retirement, we can reduce the likelihood that we're going to have taxes on our Social Security, that we can have taxes on our Medicare, right? We have that IRMAA cost that comes along whenever we all of a sudden would like to use our money and we bump over these artificially created thresholds. So because you've done well, because you've saved, because you put money away, and because your accountant and the person who was in basically they were sitting there and they were helping you with your benefits and they were working at how much money should you put in your 401k, you should get the company match. And while there's nothing wrong with that, following the conventional wisdom also set you up to pay the most possible taxes in retirement. And so we have this opportunity. If you've watched our other episodes that have talked about taxes, you know that right now we are in the most tax advantaged place that we can possibly be in as far as our brackets. We have these very, very, very tall, high bracket ceilings that allow us to pay 22 or 24% in taxes, or even 32%, depending on what you're looking at. We have these really high ceilings that allow us to pay a much reduced tax than what we would have been able to do previously. So the 22% looked more like 25, even into 28. The 24% looked more like 28 to 35%. So you can see right off the bat, if we're always going to have to pay the taxes, if we've got accounts that are forever taxable, it might make sense to start to pay some of the taxes early. Because we know today that we've got this 22, 24%, and we know that having those very tall ceilings and being able to decide, right, or to use this particular tax status that we have currently to our advantage, we can control the fact that in the future, we won't have to pay taxes on those dollars again when we do it the right way. And it's very important that whenever we decide to pay these taxes, that we aren't taking those dollars and then just putting them in what we call a tag account or a tax as you go account. Because if we take these forever taxable dollars and we put them into another taxable account, we really haven't accomplished everything that we could. And we've reduced our opportunity size. And doing that will probably also in the future trigger taxes on our Social Security. However, if we go from fully taxable to completely tax-free, then all of a sudden we're in a better position. And by the way, did you know that there are other opportunities out there where we can actually offset the taxes owed? So we can actually even push up further into those higher tax brackets and then use a tax offset to be able to reduce the amount of taxes we actually owe, and we can create an investment instead of a tax bill. And this may sound familiar, or it may sound like something you've never heard of. And no matter which way that leans, my guess is that you have not actually taken the time to sit down with someone who organized it for you. You may be doing a ton of research. You may be going out and trying to study and read the tax code. But in the meantime, you still have a day job, right? You're still going out and maybe you are the owner of a company, or maybe you're the CEO, or maybe you're an engineer, or maybe you build houses, or maybe you're an electrician, or whatever it is that you do. You're a teacher. Your everyday job is not looking at taxes. Your everyday job is not looking at how the organization of taxes will actually benefit you. That's my job, right? I work with tax mitigation specialists. I work with people that this is what they do every single day. And when we're working with a client and we take you to our tax strategists, they're going to look at two things simultaneously, because if we only look at one, it becomes very foggy, right? We don't know what we're looking at. It's almost like somebody put a film in front of our eyes and we're trying to, peek through and see what's happening rather than actually knowing. So we always start with the first model, which is, hey, based on your income, based on your future income, meaning things like Social Security, pension, maybe rental income, business income, whatever that looks like. But once we try to go into our exit, once we hit this retirement, what does that look like? What are the taxes going to look like? Then we do what we call a do nothing. So we'll organize it and we'll strategize and we'll show you, hey, based on your numbers, based on what this looks like in the future, if we had never met, over the next 20 to 30 years while you're in retirement, these are the costs that would be associated with taxes or IRMAA or these other things that you would have to pay if we never met. What do the taxes look like if we had never talked? And if everything stayed the same, so if we never see an increase in taxes, if it just kind of floated along at our current pace, what would that look like? Then we will talk about basic tax mitigation, and we're not going to ask you to follow us blindly. We're going to step you through how our logic works, how the organization of it works, what steps you're going to need to take in order to do what we call basic tax mitigation. And then, hey, what does our tax bill look like at the same interval at 10, 20, 30 years? What would our taxes look like if we were operating under the same principles that we have today, under the same tax code that we have today, under the same ceilings or the same levels of taxes that we have today? And how would it improve? What would it look like? And then for some of you, depending on what this looks like, basic tax strategy is good, but it's not great. And so then we'll add an extra layer of tax strategy, or maybe some tax offsets, some different things where you can have an investment instead of a tax bill. And we'll talk about advanced tax strategy. We'll talk about, okay, if we implement this extra layer of tax strategy, how many taxes would you pay then? And then we look at all three, one next to the other, next to the other, so that you have a very clear picture of what it is that makes sense for your life. And depending on how you are, or who you are, or what dollars you have and where they're located, will depend on which one we do. Every once in a great while, very rarely, very, very rarely, does option one ever look better than option two or option three. But if option one of the do nothing we never met actually looks better, we'll tell you. We'll say, hey, you know what? You're on a great path. As a matter of fact, tax mitigation doesn't make sense for you because of the tax brackets that you're in. And what we would ask you to do would actually be harmful. So please don't do that. Please stick with the strategy you're in. But for the vast majority, I'm going to say for 95 to 98% of people we sit down with, option two or three makes the most sense. And those particular options very much have to do with personality. So what do you want to do to mitigate the taxes? How long do you want to spend on it? What are we going to do to be able to optimize the years that we have in the beginning to reduce down the overall taxes in the future? And what do those numbers look like? How is that organized? What makes the most sense? When you're doing tax mitigation, you're not just reducing taxes this year in order to pay them down the road. You're actually reducing down your lifetime tax bill. So we're not avoiding taxes, we're not evading taxes, we're not kicking the can down the road. We are systematically rolling the taxes off, paying them at advantageous times in the advantageous brackets that we have, or using an offset to do so. And we're putting ourselves into a position that we control how much the government gets. And if you've created a tax bill for yourself, you can't evade them. That's against the rules. But you can use the rules to reduce down the overall dollars that will end up in the government's pocket. And by the way, if we do this really, really well and we set this up the right way, we can exponentially increase the dollars that you don't use that are going to go to your family, that are going to go to generations after you, and do it in the most tax efficient or tax-free way possible. Because again, we're not changing the rule book. The rule book is the rule book, no matter who you are. We are, however, reading it the right way, organizing you the right way, so that your family's receiving of those dollars is tax-free into the future. So that roughly 10 years after you're gone, those dollars can grow tax-free for your beneficiaries. So those dollars can move to them tax-free, and not just a step up in basis. A step up in basis is nice. It doesn't create tax-free dollars after you're gone. It doesn't create the shift into the tax-free growth for the full 10 years after you're gone. And while we might not be able to do this with every dollar or every asset that you would pass along, we can do it with a lot of them. And we can tell you, hey, these are the dollars I'd spend first. These are the dollars I'd spend second. And these are the dollars that I would preserve as long as possible. And it doesn't mean that you can't use your money. It also doesn't mean that simply using the dollars in the right order is going to guarantee success. It's actually the combination of the two things together that create long-term success. Because if we can remove the IRS out of your retirement, or at least drastically reduce its impact, then we can help to set you up for less need, simply because we're not profit sharing throughout our entire lifetime. And the same dollars that you pull out are more efficient. They are able to grow more efficiently. They're able to be used more efficiently, and efficiency is the key. And so let's sit down. Let's talk about how we can use your same dollars so that rather than being person B who doesn't organize, who just kind of sleepwalks into retirement, we can be person A who was strategic, who was smart, who helped to build the structure, who did it in a way that made the most sense so that you can have an exponentially better retirement, an exponentially better transfer of this wealth, and that you can control the timing and you can use the tax code to your benefit, and you can push these things out to yourself and to your family in a manner where you control the outcome. So if this has been informational for you, if you have opened your eyes and looked at your dollars a little bit differently today, please like and subscribe, share us with a friend, and do us a favor. Set an appointment. Do yourself a favor. Set an appointment. Go to www.leadershiplegacypro.com, click the link, set your appointment. Let's talk about your particular situation, because if there is one thing we know, it's that your particular situation deserves more than guesswork. It deserves intention and structure and organization and efficiency. So let us help you. Please don't use this as legal, tax, or financial advice. We know that we need to sit down with you. We need to look at your particular numbers to be able to help you to organize yourself for the future. And remember, that conversation is completely free. We believe in what we do so much that we are willing to have that consultation be free, because we know once you see the value, once you see what it can do for you and your family, you're going to want it too. So I'm Rebecca Schriver. Thank you so much for watching. Like, subscribe, share us with a friend, and we'll see you next week.